Ladies and gentlemen, every year investors ask the same question in a different tone. Is the market going up? Is the market going down? Should I wait? Is it too late? But the wrong question creates weak investors, because markets don't reward people who predict direction. Markets reward people who understand transformation. Bull markets make people comfortable. Bear markets make people emotional. But real wealth is built by those who stay focused on what's changing the world underneath the noise. And that's the mindset we need for 2026. Not fear, not hype, not short-term guessing. We need clarity about power shifts in the global economy, because right now, whether markets swing up or down in the short term, two forces are reshaping business, governments, industries, and daily life at a scale we haven't seen in decades. These are not trends, these are structural revolutions, and the companies leading them, they're not just stocks, they're infrastructure for the future. First game changer, the AI and computing backbone. Everyone talks about artificial intelligence, but here's what most investors get wrong. AI is not just software, AI is electricity for the 21st century. And electricity didn't create value because people talked about it. It created value because someone built the power plants, the wires, the grids. The same thing is happening now. Every chatbot, every automation system, every self-driving algorithm, every smart factory, every AI medical tool, they all run on one thing: massive computing power, data centers, advanced chips, cloud infrastructure, high-performance networks. We are entering a world where compute power, economic power, nations are competing for it, corporations depend on it, startups are built on it, defense systems rely on it. This isn't optional spending. This is foundational spending, which means the companies supplying the core AI infrastructure are not riding a hype wave. They are building the roads and bridges of the digital economy. In 2026, these firms won't just be tech stocks. They will be productivity enablers, cost reducers, innovation accelerators, national strategic assets. When the economy slows, companies still invest in efficiency. When the economy grows, they invest even more in expansion. That's what makes this sector powerful. It wins in caution, it wins in growth. This is not about apps, this is about the engine of modern business. And the companies that dominate advanced computing, AI chips, and cloud scale infrastructure, they are positioned to shape the next decade the way oil companies shaped the 20th century. Second game changer, financial infrastructure and the new money system. Now let's talk about money itself. For centuries, finance changed slowly. Banks looked the same. Payments looked the same. Systems moved cautiously. That era is over. We are witnessing a complete rewiring of global finance, digital payments, real-time transfers, embedded finance, AI-driven risk systems, cybersecurity arms races, global capital flows at machine speed. Money is becoming software, and when something becomes software, three things happen. It moves faster, it scales globally, it becomes deeply integrated to everything. Cars now have payments. Apps now offer banking. E-commerce platforms are financial hubs. Businesses embed lending into checkout screens. But here's the part people overlook. Behind all of this innovation, there must be trusted, large-scale financial infrastructure. Risk systems, fraud detection, compliance engines, settlement networks, institutional balance sheets. The world cannot run on experimental finance alone. It needs financial highways, secure, regulated, resilient. That's where leading global financial institutions and payment infrastructure giants step in. These companies are no longer just banks or payment processors. They are technology companies with banking licenses, data companies with risk engines, security companies protecting trillions in value. In volatile markets, strong financial infrastructure becomes even more valuable. When uncertainty rises, trust becomes currency, and the firms that combine scale, technology, regulation, global reach become the pillars of the modern economy. That's not cyclical, that's structural. Why these two forces win even if markets struggle. Now here's the key point investors miss. You don't need a perfect economy for these themes to grow. If growth slows, businesses invest in AI to cut costs. If growth accelerates, businesses invest in AI to scale faster. If markets are calm, finance expands digitally. If markets are volatile, a trusted financial infrastructure becomes critical. These are not luxury sectors. They are survival sectors for modern economies. That's why the smartest long-term capital isn't chasing fads. It's flowing into the brains of the digital world, the bloodstream of the financial world. The investor mindset for 2026, here's the uncomfortable truth. The market will scare you in 2026. There will be headlines about recession, headlines about bubbles, headlines about geopolitics, headlines about regulation. But wealth is not built by reacting to noise. It's built by asking, is this company becoming more essential to the global system? If the answer is yes, volatility is opportunity, not danger, Because game-changing companies don't just grow earnings. They grow importance, and importance is what drives long-term value. Final thought, market up, market down, that's weather. But AI infrastructure and modern financial systems, that's climate. And you don't build long-term wealth by trading the weather. You build it by investing in the climate shifts that redefine the world. 2026 will test patience. It will test conviction. But for those focused on the companies powering intelligence and enabling global finance, the question won't be, was the market volatile? The question will be, did you recognize the transformation while others were distracted? Because the biggest opportunities rarely look calm, they look uncertain. And that's exactly where the future is built. The 2026 game changers explained. We talked about the forces. Now let's talk about the companies that sit at the center of those forces. Not trendy names, not meme stocks, not hype cycles. We're talking about system-level companies, the kind the global economy quietly depends on. Jam, Chad, GR51, the company powering the AI age. This is the firm that doesn't just use AI, it supplies the intelligence engine. Think about what's happening right now. Every corporation wants AI, every government wants AI, every startup is built on AI, but AI doesn't run on hope, it runs on advanced processors, high-performance chips, data center architecture, specialized computing systems, and here's the reality most investors miss. We are in the early innings of AI infrastructure build-out. This is like the internet in the 1990s, but instead of websites, the demand is for raw computational power. Training AI models costs billions, running them costs billions more, upgrading them constant. This is not a one-time purchase. This is a permanent global arms race in computing power. Companies, governments, and defense agencies cannot fall behind because AI leadership now equals economic leadership, military advantage, productivity dominance. That means spending in this space is strategic, not optional. The leading company in this area benefits from three powerful advantages. One, it sits at the bottleneck. Not everyone can design cutting-edge AI processors. It requires decades of engineering, specialized architecture, massive R&D, global manufacturing partnerships. That creates a moat so deep that competitors don't just need money, they need time. And time is the one thing the world doesn't have in the AI race. Two, it earns from the entire ecosystem. This company doesn't depend on one app or trend. It sells to cloud giants, governments, enterprises, universities, research labs, startups. It profits from the entire AI explosion, not one winner. It's like selling shovels in a gold rush, except these shovels are advanced silicon brains. 3, AI demand survives any economy. Recession, companies automate faster. Boom times, companies expand faster. Either way, AI adoption accelerates. That makes this stock tied not to cycles, but to the digitization of human work itself. In 2026, this type of company isn't just tech. It's core infrastructure of civilization. GEMCAD, GRFA2, the financial super platform. Now let's shift to money, because the second game changer is the company that sits at the center of global financial flows. Here's what people underestimate. The world isn't just going digital. Money is going real time, data-driven, and globally connected. But when trillions of dollars move instantly, the world needs fraud protection, risk modeling, compliance systems, settlement networks, institutional-grade security. And this is where the financial super platform wins. This type of company is not a traditional bank. It's a financial technology backbone with global scale. It operates the systems that allow businesses to accept payments worldwide, banks to process transactions securely, consumers to tap, click, and transfer instantly, governments to move money safely. And here's why this becomes explosive in 2260. One, cash is disappearing. Digital payments are growing everywhere. Emerging markets, developed nations, online, offline, mobile, embedded. Every time money moves digitally, this platform earns. It's not betting on one country, it's riding the global shift away from physical money. 2, risk and trust become more valuable in chaos. In volatile markets, fraud rises, cybercrime rises, financial complexity rises. And when risk rises, the platforms with the best data and protection systems become essential. These firms don't just process payments, they are defense systems for global finance. 3, they scale with the economy itself. When e-commerce grows, they grow. When cross-border trade grows, they grow. When digital wallets grow, they grow. They are attached to the flow of global economic activity, not one sector, everything. Why these two together are so powerful. One powers intelligence, the other powers money. AI changes how work gets done. Financial infrastructure changes how value moves. One is the brain of the digital economy. The other is the circulatory system. And in 2026, both are expanding, strategic, essential, hard to replace. That's the combination long-term capital hunts for. The big insight most investors miss. People try to time markets. Smart investors track inevitabilities. AI infrastructure growth inevitable. Digital financial systems, inevitable. The question isn't if these grow, it's who controls the highways of those systems. Because the companies controlling the highways don't just participate in growth, they tax the growth of everyone else, closing build up. So when people ask ye, will the market be up in 2026? Will there be a crash? Should I wait? The sharper question is, which companies become more important to the world every year, regardless of noise? Because when a company becomes more essential than it was 5 years ago, and more essential than it is today, time becomes your ally. And that's how real fortunes are built. The risks, the doubts, and why these giants still win. If an opportunity looks perfect, it's usually crowded, and crowded trades don't make legends. So let's address the tension in the room, because 2026 will not feel safe. You'll hear AI is a bubble, tech is overvalued, regulation is coming, a recession will crush earnings, financial systems are under pressure, and those fears, they're not crazy. They're exactly what make great long-term entries possible. Let's break the doubts down. Risk phase one, AI is a bubble. Yes, excitement is high. Yes, valuations have expanded. Yes, speculation exists. But bubbles happen when narrative to a reality. What's happening here is different. We already see companies replacing labor with AI, hospitals using AI diagnostics, governments investing in AI defense, businesses restructuring around automation. This isn't future promise. This is present adoption. And more importantly, the AI infrastructure leaders are not selling dreams. They are selling hardware, compute time, and systems already in demand. Orders are real. Data centers are being built. Budgets are allocated. That's not a bubble dynamic. That's an industrial expansion cycle. Even if hype cools, the physical infrastructure build-out continues. Risk phase two. What if there's a recession? Here's the twist. Recessions accelerate AI adoption. When growth slows, CEOs ask one question: how do we cut costs without killing automation? AI, efficiency, software. And on the financial side, during uncertainty, digital payments don't stop. Fraud protection becomes more critical. Risk modeling becomes more important. Trusted platforms gain market share. Weak players struggle. Strong infrastructure players become more central. Economic stress often consolidates power toward leaders. Risk phase three, regulation, big tech, big finance, big data. Regulators would absolutely get involved. But here's what smart investors understand. Regulation often protects giants. Why? Because compliance is expensive. Small players struggle with rules. Global leaders can afford teams, systems, legal frameworks. Barriers to entry rise. And when barriers rise, the dominant companies often become even harder to displace. Regulation may slow the pace, but it strengthens the moat. Risk phase four, they're already too big. People said that about oil majors, telecom giants. Consumer staples, cloud leaders, but size when tied to infrastructure can be a weapon, because scale means better data, lower costs, stronger partnerships, deeper ecosystems. These companies don't just grow by selling more, they grow by becoming impossible to remove from the system. And when a company becomes system critical, it doesn't compete like a startup. It operates like economic plumbing. The real advantage, they win in chaos. Here's the truth most investors learn too late. Fragile companies shine in good times. Essential companies prove themselves in bad times. AI infrastructure and financial super platforms sit at the core of productivity, security, digital commerce, global connectivity. They are not luxuries, they are requirements. When pressure hits, spending shifts toward what keeps the system running, and that's exactly where these two forces live. The psychological edge, 2026 won't just test markets, it will test your emotion. Volatility shakes out the impatient, the over-leveraged, the narrative chasers. But the investors who understand structural shifts stay grounded, because they're not buying for next quarter, they're buying for the world that must exist 5-10 years from now, and in that world, AI doesn't disappear. Digital finance doesn't go backward. Compute demand doesn't shrink. The direction of progress is not in doubt. Only the path will be noisy. Final message of part 3. So yes, there will be pullbacks. Yes, headlines will sound scary. Yes, markets will wobble. But volatility is not the enemy of great investments. It's the entrance fee, because game-changing companies don't move in straight lines. They move through doubt, resistance, fear, and disbelief. And by the time they look safe, again, the opportunity is gone. How smart investors position themselves. The biggest myth in investing is this: that great returns come from bold predictions. They come from structured patience. The investors who win big in companies that reshape the world don't go all in. They don't chase green candles. They don't panic on red days. They use a strategy built on one ideas, inevitable trends plus emotional discipline to long-term outperformance. Let's break down how pros actually handle giants like AI, infrastructure leaders, and financial super platforms. Step 1, they build positions, not bets. Amateurs bet, professionals build. A bet says, I'm right now. A position says, I believe this company becomes more important over time, so instead of dumping all capital at once, smart investors enter gradually, add during pullbacks. Let time smooth volatility, because with transformational companies, timing the bottom matters less than time in the system. You're not trading noise, you're attaching yourself to a long-term power shift. Step 2, they respect volatility instead of fearing it. Here's what most people do. Stock drops 15%, they panic. Stock rises 15%, by excitement. Pros flip that psychology. When leaders drop due to macro fear, not broken fundamentals, they see the business didn't change, the price did. Volatility becomes a discount mechanism, a chance to increase ownership, a transfer of shares from emotional hands to patient ones. The same headlines that scare retail investors often create opportunity for disciplined capital. Step 3, they focus on importance, not just price. Price moves daily, importance compounds slowly. Ask the question pros ask, is this company becoming more central to the global system each year? For AI infrastructure firms, more industries depend on their compute, more governments rely on their technology, more software is built on their platforms. For financial super platforms, more transactions flow through them, more data improves fraud systems, more economies digitize money, that's increasing system importance. And system importance tends to turn into long-term revenue power. Step 4, they give winners time to become giants. The biggest mistake investors make with transformational companies, selling too early. They treat 40% gains like victory, but history shows something different. The companies that reshape industries often run for years, not months, because their growth isn't a trend, it's a structural expansion cycle. AI adoption, years, digital financial transformation by decades. Professionals understand you don't interrupt compounding just because a stock had a strong year. You reassess fundamentals, not emotions. Step 5, they diversify within strength, not weakness. Smart positioning doesn't mean putting everything in one name. It means spreading exposure across related strength. AI hardware, cloud platforms, cybersecurity, payment networks, financial data systems, all connected to the same macro force. The digitalization of intelligence and money, that's not random diversification. That's thematic dominance. What pros don't do. They don't chase hype spikes, panic sell on headlines, try to predict every market move, trade based on social media excitement, because they understand wealth in structural leaders is built through ownership, not constant action. The big secret, you don't need to be right every week. You need to be right about what the world is becoming. And in the world ahead, AI becomes infrastructure, finance becomes software, compute becomes power, digital trust becomes currency. So pros align themselves with those realities, and then they let time scale and inevitability do the heavy lifting. Closing line for part 4. The market will move fast, the news will move faster, but transformational wealth is built slowly by those calm enough to hold the future while others trade the present. What could go right that nobody is pricing in? Markets are very good at pricing fear. They are terrible at pricing acceleration. And with transformational companies, the biggest upside rarely comes from the obvious story. It comes from the second order effects, the ripple waves nobody modeled. Let's look at what the market might be underestimating for our 2026 game changers. Upside surprise, phase 1, AI demand doesn't grow, it explodes. Most forecasts assume steady AI adoption. But what if adoption doesn't move in a straight line? What if we hit a tipping point? Think about this. AI models get dramatically better, cost per task drop fast, tools become easier to use. Entire job categories integrate AI by default. Suddenly AI isn't a department tool, it becomes the operating layer of business. That means every company needs more compute, every industry upgrades infrastructure, every government scales AI capability instead of gradual growth. We get a global compute arms race, and the company supplying the brains of that system doesn't just grow revenue, it becomes a capacity-constrained asset where demand outpaces supply for years. That's when pricing power appears, and pricing power in infrastructure businesses is where earnings can leap, not crawl. Upside surprise, phase 2. Entire economies leapfrog into digital finance. Emerging markets are still heavily cash-based, but mobile adoption is exploding, internet access is expanding, young populations are digital first. If digital finance adoption accelerates faster than expected, financial super platforms don't just grow, they tap into billions of new users entering the system, each transaction small, but in aggregate, massive. And unlike traditional banking expansion, which takes branches in years, digital financial infrastructure scales almost instantly once systems are in place. That's exponential economics, Upside surprise 83. AI for finance converge. Here's the wild card most people aren't modeling. AI doesn't just help businesses, it transforms finance itself. Risk analysis becomes smarter, fraud detection becomes predictive, credit decisions become data-driven, compliance becomes automated. That means financial platforms that integrate AI deeply don't just process money. They become intelligent financial networks. Smarter systems reduce losses, increase trust, and unlock new services, which leads to more volume, better margins, stronger competitive moats. It's a compounding loop. Upside surprise 84, productivity shock. For years, global productivity growth has been sluggish. AI could change that. If AI meaningfully boosts productivity across sectors, say corporate profits rise, economic growth accelerates, investment spending increases, and guess who sits at the center of that productivity revolution? The AI infrastructure providers. It's like selling engines during the Industrial Revolution. You don't just grow with one company. You grow with every company becoming more efficient. Upside surprise 85, governments double down. We already see nations racing in AI, but geopolitical tension could escalate investment further. National AI capability becomes economic strategy, defense priority, technological sovereignty. That means long-term contracts, subsidies, and domestic build-outs, all benefiting core or infrastructure providers. Government spending isn't short-term hype, it's multi-year commitment. What this means, here's the key: markets often price-based. Case scenarios, they struggle to pricey tipping points. Network effects, exponential adoption, strategic urgency. When those forces hit together, growth doesn't move linearly, it bends upward. And when infrastructure companies are at the center of that bend, they don't just grow, they re-rate. Closing message of part 5, the downside risks create volatility, but the upside surprises create generational moves. And those moves rarely come from companies selling trends. They come from companies supplying the foundation of a new era, the long-term vision where these giants could be by 2030. Most people underestimate change because they measure the future in quarters. Transformational investors measure in eras. And when we look toward 2030, the question isn't, will these companies grow? The real question is, how deeply embedded in civilization do they become? Because by the end of this decade, we may not be talking about these firms as leaders. We may be talking about them as foundations. By 2030, AI infrastructure may be like electricity. Today, AI feels like a powerful tool. By 2030, it may feel like a utility. Businesses won't ask, should we use AI? They'll ask, why isn't this AI optimized yet? Every workflow, every factory, every hospital, every logistics network, every research lab running on AI models that require massive computational backbones. That turns the leading AI infrastructure company into something bigger than a chip maker or tech supplier. It becomes a global productivity engine, a national strategic asset, a critical layer of economic output. And companies that become economic layers don't grow like normal firms. They grow with the expansion of the entire digital economy. By 2030, money may be fully digital by default. Think about how quickly behavior changes. A decade ago, mobile payments felt optional. Now they're normal. By 2030, physical cash may be rare in major economies. Cross-border payments could be near instant. Digital wallets may replace traditional accounts. Financial services may be embedded everywhere. That means the financial super platform evolves from a payment processor into a global financial operating system. It won't just move money, it will score risk, detect fraud, enable lending, power digital commerce, connect economies. The more digital money flows, the more central this platform becomes. And when you sit at the center of financial flows, you grow with global GDP, e-commerce, digital services, international trade. That's a powerful place to be. By 2030, intelligence and money merge. Here's where things get interesting. The AI company provides intelligence. The financial platform provides transaction capability, but the future blends both: smart systems that approve credit instantly, predict fraud before it happens, optimize spending, allocate capital more efficiently. That creates a world where money moves faster, decisions get smarter, systems get more automated, and the companies at the intersection of those forces don't just benefit from growth, they enable growth. They become part of national strategy. When technologies become this important, they stop being just businesses. They become policy priorities, strategic partnerships, economic pillars. Governments don't ignore firms that power national AI capability. Financial system resilience, cybersecurity infrastructure, that creates stability of demand. Few industries enjoy what that means for investors. When a company becomes hard to replace, critical to economies, embedded in daily life, it gains something more valuable than hype: durability. Durable growth beats explosive but temporary growth. Because compounding over years and system-level companies can create outcomes far beyond early expectations. The final perspective: markets will rise, markets will fall, cycles will come and go. But by 2030, we may look back and realize the biggest opportunity of the decade wasn't predicting recessions. It was recognizing which companies were quietly becoming indispensable to the modern world. Final line of the full speech: the future won't be built by companies chasing trends. It will be built by companies powering intelligence and moving value. And those who aligned with those forces early won't just have invested in stocks, they will have invested in the architecture of the next era.